This is Bloomberg UTV.
Hello and welcome to your Eye on the Week. This week in focus is the upcoming monetary policy review and whether it will really bring in the first dose of serious monetary tightening. And if so, what repercussions will it have? But before we ask our experts those questions, here's a look at the cues we are going into the policy review with and why so many experts believe that the stage for tightening has been pretty much set.
The trade-off between maintaining the stimulus until recovery is firmly in place and withdrawing it soon enough so that inflationary forces do not get hold is a judgment call. A judgment call every central bank will have to make.
That's what RBI Governor Dr. Subbarao said on the 10th of September last year. And in the first of the monetary policy reviews in the new year, this is going to be the big issue to watch out for: how to handle inflation and stimulus withdrawal and ensure growth. The signals from the ground paint a tough picture. Inflation is at a high, food inflation has hit an 11-year high and growth is robust. And just recently in the neighborhood, China, facing similar challenges, raised the equivalent of the cash reserve ratio, or the amount that banks need to park with the central bank. So is the state set for a similar move here?
If I look at India or if I look at China, I'm seeing two of the best performing economies in the world. And of course the price you have to pay is higher inflation. And that means higher interest rates. I'm not be surprised in the slightest that RBI tightens monetary policy in the next month.
The stage for a reversal in the monetary tone was of course set in the last pronouncement when the RBI made its intentions clear by hiking the SLR, or the standard liquidity ratio, the amount of cash that banks need to have on their books. So what kind of policy changes is the RBI expected to make, with the credit growth still largely sluggish and signs of heating up on the ground? Few people doubt the direction rates will take over the next year or two. But the big question is the timeline the RBI will adopt, because raising rates is far more tough than lowering them.
Well, joining me for the discussion are Sheth, Chief Economist at Macro Sutra, and Sumeet, Vaid, Certified Financial Planner at Ffreedom. Thank you both for joining me. That package ended with a note that hiking rates is far tougher than lowering them. And God knows the situation on the ground is very, very mixed. Do you think there will be a 25 to 50 basis point hike in CRR, and what does it mean for rates?
Sure. I do think that there will be a hike in the CRR about the level that you said. What it means for rates for you and me or for corporates borrowing, I think in the near term, it will probably not affect those rates much because there's just so much liquidity in the system. The banking system is flush with liquidity. Globally, there's still abundant liquidity. Rates are at historic lows. That global money is wanting to come into the country. So I think the rates will not go up for you and me, for corporates, in the near term. But I do think that the time has come to take a call on rate hikes, and they will.
Right, Sumeet, a lot of decisions on taking loans are based not on now, but what the outlook on rates are.
Sure.
Now, if this is the beginning of the year, what impact will it have on people looking at house loans, looking at rates? Will it have a deep psychological impact?
Definitely. I think there's a huge behavioral side to this whole rate bit which goes on, and all these newses does make impact in terms of purchasing decisions or purchasing behavior of customer itself. So a lot of these people have been fence sitters for a very long time. What they're trying to take sense on is my job secure? Is my earning going to happen the way it has been happening? Because the jobs have been secured, earnings have been looking good, now it's time when they're going to take the decision. And suddenly they start hearing the news on interest rates tightening again. We need
So what we've heard on the retail credit really growing is not really growing, according to you?
It's just starting. It's just starting. It hasn't really taken up the shape the way it should have taken up.
You know, the problem of hiking rates much before anybody else hikes rates is also huge, because what it really means is that FIs, hot money comes in because they use the differential window, and for God knows, I mean, China is also looking towards hardening of rates. So can we really go ahead and harden far before anybody else?
I think they have to send a signal to the markets, to the domestic markets as well as the global markets, that inflation is something they will not stand for. You don't want to be known as an economy where inflation is tolerated. That's bad, not just for consumption, it's bad for investment, it's bad for flows as well. So I think that is the signal, the major signal that the RBI is sending. Will it have the opposite impact of what they intend? They intend to keep liquidity down by taking more out through the CRR, but arbitrage-driven flows will come in and show that that is a risk that they're taking. But I think they want to take that risk to send that signal. And even the arbitrage flows that come in, they have other instruments at their disposal to perhaps make sure that those flows are channeled into not an asset bubble, but into real investment.
Right. Sumeet, the dichotomy is that, prices hurt far more than higher rates if you're looking at investments at the individual level. Also, you're seeing a situation where automobile companies are raising prices because of input costs going up. You have a specter of hardening rates. How is this going to play out on the psyche and the spending of consumers?
I think this adds to the confusion. And I'll go back to my earlier answer where I started off by saying the psychology is just changing right now. And when it gets impacted for a longer period of time. If the customer is going to experience the interest rate on the loan side itself, it is going to further put him into the shell. Everything is about consumption. We are now starting the consumption. My worry as a financial planner and also as a consumer myself for a long-term period is, will our consumption get nipped in the bud just when it was starting?
Is there a fear of that?
I think that credit-driven consumption, perhaps, this will have some impact on. But I think, as long as your wage outlook and your income outlook is good, your consumption is not going to fall off the cliff. Is it possible that what a rate hike would do by making the cost of capital higher means that investment plans are less ambitious than they once were?